Imagine opening your trading platform and discovering that your biggest risk was never position size, leverage, market volatility, or your strategy. It was your nervous system. Most traders treat emotions as some vague psychological problem. They'll say things like, "I fell off today. I got nervous. I lost discipline." Those statements sound meaningful, but from a quantitative perspective, they're almost useless. Because if you can't measure something, you can't model it. And if you can't model it, you can't manage it. Today, I'm going to show you how professional traders can quantify emotional risk using journal data and performance metrics, turning anxiety, stress, hesitation, and fear into objective variables that can be measured alongside win rate, expectancy, and drawdown. Because emotional risk is real risk. And if you don't price it into your system, eventually the market will. Most traders separate technical performance from psychological performance. They'll analyze win percentage, risk to reward, average return per trade, maximum drawdown, profit factor. Then they'll treat emotions as a completely different category. But that's backwards. Emotions don't exist outside the system. They exist inside the execution process. And execution determines whether your statistical edge survives contact with reality. Here's an example. Let's say your back-tested strategy produces a 56% win rate with a 1.8 to 1 reward-to-risk ratio. Mathematically, you have edge. But during live trading, you begin exiting positions early. You hesitate before entries. You widen stops. You skip valid setups. Now your actual win rate falls to 48%. Your average reward shrinks. Suddenly, your edge disappears. Your strategy didn't fail. Your emotional friction altered execution variables. And that's measurable. Here's where we move from psychology into data science. Start adding an emotional layer to your trading journal. For every trade, record, stress score from 1 through 10, energy level, confidence level, urgency level, and physical signals. Things like elevated heart rate, sweaty palms, muscle tension, rapid decision-making, tunnel vision, shallow breathing. Don't overcomplicate this. The goal isn't therapy. The goal is data acquisition. Now combine that with your normal trading metrics. Entry quality, slippage, hold time, maximum adverse excursion, maximum favorable excursion, or multiple, profit or loss. Then something interesting starts happening. You stop asking, "Was I emotional?" and start asking, "What measurable distortions occurred when stress increased?" Because emotional risk rarely appears directly. It appears indirectly through behavior. Now, let's assume you collect data over 100 trades. You sort trades by stress score. Maybe stress levels 1 through 3 look normal. Win rate is stable. Average hold time remains consistent. Execution quality is strong. But then stress levels above 7 begin showing patterns. Average slippage increases 35%. Hold times decrease by 40%. Premature exits double. Risk-reward deteriorates. Expected value starts collapsing. Now you've identified something extremely important. You haven't discovered an emotional issue. You discovered a risk threshold, a point where your psychology begins interfering with mathematical expectancy. Think of it like temperature limits on an engine. An engine can operate efficiently at certain ranges. Beyond that threshold, performance degrades. Human decision-making works exactly the same way. Your emotional state has an operating range. Beyond that range, edge leakage begins. And now you can quantify it. This is where most traders stop. But this is where professionals begin. Once you've identified your threshold, you build rules around it. For example, if stress exceeds 7 out of 10, reduce position size by 50%. Or stop trading after 2 high-stress entries. Or move from discretionary execution to mechanical execution only. Or require higher setup quality before entering. Now your emotional profile becomes integrated into risk management. Think about what institutions do. They don't assume traders perform perfectly under every condition. They create systems around human weakness. You should do exactly the same thing. Because emotional capital is still capital. And capital that becomes impaired requires exposure reduction. Most traders obsess over finding a better indicator, a better setup, a better strategy. But often the missing variable isn't on the chart. It's inside the person reading the chart. The market doesn't care what you feel, but your execution absolutely does. So stop treating anxiety as an invisible force. Measure it, track it, correlate it against your data. Find where emotional friction begins damaging expectancy. Because the moment fear becomes measurable, it stops being mysterious. And the moment it stops being mysterious, it becomes manageable. Your trading edge isn't just your strategy. It's the distance between what your system should do and what you actually do under pressure. Reduce that gap, and everything changes.